conversation with our alpha manager and a very rare guest at that, Sukumar Raja, or our Sukumar as he's very well known. Sukumar, we left off before going into the commercial break talking about what the outside view on India is. Talk us through where you rank India right now in terms of investment opportunity across the world. And I mean not only in the emerging market hierarchy, but also compared to, let's say, money moving into the US now that we are seeing signs of an economic recovery there.
India, in my view, is one of the top destinations. And in fact, some of the Asia strategies I run, it's the biggest single overweight market, and it is because of combination of very strong long-term fundamentals for the economy, and also I find a lot of interesting opportunities. In terms of interesting stocks to invest in. So clearly, India is probably the most attractive opportunity among all the markets that I follow at this point of time, and I think that view is spreading among a wider section of investors at this point of time.
So when you say wider section, are you seeing definitely more interest amongst global large investors, in terms of topping up their India investments, or at least beginning to invest in India if they had ignored this market earlier on? Can you give us a sense of whether you expect FII flows to continue with the same momentum into this market or an increased momentum? How do you see them approaching India?
Over the last 6 months, the confidence in the economic prospects of India has improved substantially. Today, there are very few people who are skeptical about the sustainability of growth or improvement in the economic parameters. There are some people who are questioning whether the market has run up too fast. But my view is that the earnings growth is going to be very meaningful in the next 3 to 4 years. And currently, the P multiple of the market is close to the long-term average. So even if you do not have a substantial expansion in the P ratio for the market, the returns can still be very attractive because of earnings growth for the stocks. And I think the most interesting part of the Indian market is the variety of stocks that are available. In the last 20 years, our funds have done much better compared to the benchmark, and that's because of a wide variety of stocks that we could pick from, and many companies which could do much better than the market, and that holds true even today. So if people can pick really good stocks, then those companies can probably deliver much better returns even compared to the market returns with themselves, which in itself might be very attractive.
You've had you've watched these markets for several decades. As Senthil pointed out earlier, you were amongst the first few investors or fund managers to call the tech boom in India. How would you describe this bull market? We've had domestic investors like Rakesh Jhunjhunwala or Ramesh Damani call it the mother of all bull markets. Would you agree that this is an unprecedented bull market? Where are we in this bull market phase, if that's easy to call at all? And do you think, or how would you differentiate, or how do you think this bull market will distinguish itself from the other big runs that we've seen in Indian equities in the past?
In terms of the index performance in this bull market, I wouldn't expect as strong a performance as the previous market. I think in the previous market it was a synchronous global boom, and many of the markets went into bubble valuations. I do not expect that to happen in the next 5 years. So the index returns for this bull market might be substantially lower compared to the last one, but I think it's going to be a healthier market, and probably fewer people are going to burn their fingers as badly as they did in the previous market.
There's lots of money, especially HNI money and maybe small investor money, looking for the next big multi-bagger, and most of that money is looking at what people think, or what they'd like to think, are well-priced mid-cap shares. How wary are you about this move into mid-caps?
We try to, segregate the mid-cap universe into companies which can sustain growth at a high rate for a long period of time, and the ones, which are gaining because of, the current re-rating of the mid-caps. So we find that less than a quarter of the mid-cap companies would fit into the first category, and the companies which can, continue to grow very fast and ultimately emerge as large-cap companies. So I think we have to be very selective in selecting mid-caps at this point of time.
Okay, I want to ask you one last question, Sukumar, on the challenges that this market faces, given that we've spent the last 15-odd minutes building out the bull case. There are many investors who are a little skeptical about how reform-oriented this government will be, and therefore, some of the things that need to be done with regards to, let's say, the aggression on disinvestment, we haven't seen that play out as yet. Privatization of public sector companies, this government clearly doesn't seem to be in favor of that. What are the chances where we stand today, given what they've already done and what is yet to be done, of there being some big disappointments on the domestic front? And of course, I cannot ignore the global scenario. So we've got a great bunch of worries on where Europe's headed, whether Japan will succeed in Abenomics or not. So what would you consider the big challenges to this bull market and how imminent they are?
On the expectation from the government, I would expect that they would be administratively very efficient and tap the low-hanging fruits that are available. So doing so can push up the economic growth rate somewhere between 7 to 8%. And I think to sustain the current the bull market, I think that is probably sufficient or more than enough. Now, if they can do something much more than that, big administrative, big legislative reforms, for example, if they do a total revamp of the labor laws and there's going to be hundreds of $billions invested in railways that improves the transportation infrastructure and so on, then the rate of growth can go to much higher levels. Then of course the story changes very dramatically. Then probably we might actually see the biggest bull market of all times. But I'm not building that at this point of time. I think there's no political consensus to do so in the next 2 to 3 years. And I'm looking at tapping the low-hanging fruits that can push up the economic growth rate to somewhere between 7 to 8%. On the global challenges, I'm not expecting a very meaningful recovery in Europe. In the case of Japan, I think Abe has gone very far, and I don't think there's going to be a reversal of the economic policy in sight in the immediate future. His popularity continues to be too high, and they moved too far in one direction to change direction at this point of time. So I see relative stability in the policy framework in Europe and Japan. Not a big pickup in growth, or neither do I see any collapse in Europe or Japan happening, though there are going to be some fears from time to time. So I would see a stable situation in these two economies. I would expect U.S. to recover earlier compared to these two. Already the unemployment has reduced, and I think U.S. was ahead in the debt restructuring cycle. So I would think that U.S. recovery should happen first, and then we would see some recovery in these economies. But I don't see the global stability being threatened too much.
All right, Sukumar, we'll leave it there. Thank you so much. Always a pleasure to speak with you. Our Sukumar there of Franklin Templeton talking us through his investment case for India.